Good morning, fellas. Thrilled to have you in the Think Tank Exchange today. It's always fun to have colleagues to just kind of talk about markets and talk about volatility. I mean, let's be honest. I mean, one of the only things that I think I feel really confident in is that we're going to have lots of volatility in these markets. So with that, for those who don't know either of you, Rob, will you give a little bit about your background and talk about your story?
Sure. Thanks for having me on. Appreciate being here. Yeah, volatility is certainly a theme now, and I don't think it's going to go anytime soon. I've been watching volatility since about 1997. 2000, became a financial advisor and got a lot of million-dollar accounts as a new financial advisor. Unfortunately, by the time that I received them, they were worth about 100, 200,000 because the advisors that have had them previous to me were over enthusiastic with tech. Diversification was holding maybe Oracle with Amazon. That was a diversification. So I learned early on that these clients that love these positions were in kind of a tough time. And I started to do call writing early on in my career, and I started to see the value of options and what they could do to help dampen volatility and capitalize on volatility as well. So my career has been mostly options, futures. I've traded futures. I had a futures fund I ran for about 4 years. I've been in the business over 20 years. I worked for some major firms, and here I am today. I'm the founder, managing partner of Occurrence Capital, and we have volatility strategies. We run some various risk-based models.
And Jim, help us out. You're the Vixologist, man. I love that.
I should have, I could put my hat on, my Vixologist hat on. I've been an investment advisor for 20 years, joined Toroso in 2019. And among sort of routine portfolio construction, I run a couple of systematic strategies that use some form of momentum, relative strength, and volatility to provide risk-adjusted returns that are hopefully attractive relative to benchmark indices. I went down the volatility rabbit hole starting in 2014, looking for an uncorrelated source of return. And I've been trading volatility exchange traded products pretty actively since 2016. So I've seen a decent range of market types and how volatility tends to behave in different markets.
I love that you explain that. This is for a lot of folks, an asset class, specifically speaking about volatility, that a lot of folks don't fully understand. And it definitely requires a deep analysis. Let's go with that a little bit, Rob. How do you manage and view VIX in the context of the occurrence product?
We look at volatility as one of the few instruments out there that is almost perfectly inverse to the S&P 500, particularly in short periods of time. Over long periods of time, it might have a negative correlation, let's say 0.78, negative 0.78. But during periods of crisis, it gets pretty close to 1. And to us, that is a very valuable tool to have to help mitigate risk. And we feel like volatility is persistent in every portfolio that's out there. That's why diversification exists, to try to mitigate volatility. But in environments like today, where you have low yields and you have a period where correlations are approaching 1 in almost every asset class, you need to have an alternative in there, some type of alternative that is, use Talib's saying, anti-fragile. I mean, what's moving in a different direction than the rest of your portfolio? So seeing the VIX and how it behaves in an inverse manner to the typically the whole portfolio attracts us, and we want to try to exploit that to dampen volatility and enhance return in our portfolios from a risk-adjusted basis.
Yeah, and maybe this is stating the obvious. The fact of the matter, we're dealing with a whole different market right now because, well, bonds aren't doing it, not as a hedge these days, right? Jim, I don't know your view on bonds specifically for client accounts, but talk to us a little bit about bonds, and how they have been used in the past for hedging, because it's just not working now.
Well, we most of us have only been in the business long enough to see a persistent downtrend in interest rates, right? I started in the business in 1983. Interest rates were still in the high teens. I remember buying some Treasury zeros, didn't buy enough of them apparently. But as we've watched that trend line down, bonds have been a great hedge in times of equity turmoil. In the back half of 2008, as one of the most recent examples, if you owned TLT, you mitigated the vast majority of your equity losses. But with interest rates now very low and reversing higher, bonds have not performed that diversification the way people are accustomed to having that. And therefore, investors and managers and advisors alike are looking for other sources of diversification, other sources of risk mitigation.
And then Rob, the problem for advisors as I talk to them, cash is not a great solution either, right? You can't sit there on 25-30% in cash right now, because, well, then your clients are saying, what are you doing for you? What are you doing for me, right? So when you're thinking about the occurrence solution, how does it fit? What's your what's the feedback you get from financial advisors about it?
Yeah, you bring up a good point. Here we're in an environment where you have inflation running 8%. The reality is, depending on how you measure it, it's probably a lot higher than that. So if you're holding cash, you could in effect be losing between 5 and 10% of your money in the next couple of years if inflation were to persist. So yeah, and clients, rightly so, are asking their advisors, what are we doing here? If you're going to cash right now, cash as an asset class in nominal terms, looks pretty good. You have $100,000 in your account 3 months ago. Well, you still have 100 grand in your account. Maybe $4 plus that. And while short term cash may seem like a good place to hide, it's a trap door, so to speak. Because if you reside in cash too long without defining how you're going to re-enter the market, and most clients that I know that have gone to cash don't have any defined way to go back into the market, you are not going to hit your goals. So the advisors I speak to try to refocus their clients and say, look, this market today is not for you. You've come to me to invest your money for the next 10, 15, 5, 20, whatever the term is. We have a plan in place. We have to stick to our plan. And that plan typically includes a diverse array of investments, like some of our vehicles that will help the advisor, dampen volatility. And I mentioned dampen volatility. The most important piece of that is to keep the client invested. We cannot have clients going to cash. You get the market moving 2 and 3%. You go to cash, and unless you're a pro and have a good market timing model, the odds are against you being successful in that venture.
Well, yeah, because you can raise the cash, feel good, but when is it going to be the right time to get back in? That's always the hardest issue, because people get comfortable, right? And I just can't lose any money. But going back to you, Rob, in your solution, it's a small allocation that has a big impact. That's the thesis behind it. Is that fair?
Correct. We developed our strategies, some of them started in 2015, 2017. One of the things we want to look at whenever you make a decision, I hear people say, hey, we're going to overweight this. Well, if you make a decision to overweight something, by definition, you have to take the money somewhere else. So you have to be right twice, because if you were right on your overweight, but where you took the money from did better, then you look poor on a relative basis. So what we wanted to do was, how can we achieve a portfolio that has some exposure to long volatility in a small enough piece where it won't drag the portfolio down and scare the investor out of the portfolio. In other words, something they could hold as a core holding. And that's where we started our research. We're looking at what's the optimum amount of dollars that we can allocate to long vol on a monthly basis without degrading and without degrading the portfolio and dragging relative to the index, dragging performance relative to the index.
Yeah, so there's a reason why I'm the ETF professor, guys. How structure matters. So I'm going to ask this question first of Jim. Walk us through the structure around VIX, so everybody can understand it. Because again, you're the Vixologist. You're the the guy.
I am. So let's start with the VIX itself. The VIX, the volatility index, is a calculation disseminated by the CBOE. It's a measurement of implied volatility over a 30-day forward time frame derived from option prices for the S&P 500 index. It's been called the fear index because it tends to rise, sometimes sharply, when investors get nervous and bid up prices for put options. It's important to note that there's no way to trade the VIX itself, but we do have futures and options that allow investors to express a view on whether they think volatility is going to rise or fall or frankly stay the same. And it's those futures and options that present the opportunity to, again, express that view in the form of a trade. And Wall Street being what it is, we've also created a number of exchange traded products that utilize primarily the VIX futures to give a packaged solution for expressing either a long vol or a short vol opinion.
And contango and backwardation, Jim,
Sure.
Walk us through a little bit on that.
Sure. So it may be useful to think of VIX futures as a form of financial insurance, right? And if you want an insurance contract that lasts for 5 days, you're going to pay less than if you want an insurance contract that lasts 10 years. And there are monthly VIX futures contracts. And the typical arrangement is that the near-term VIX futures contracts cost less than the long-term futures contracts, with that insurance analogy. And that lower left to upper right term structure is labeled contango. We don't need to go back to the Old English derivation of contango, but that's the sort of normal bull market configuration, lower left to upper right fixed term structure. Every once in a while, the markets panic, and the near-term insurance, the cost of near-term insurance gets jacked up, and it may get jacked up to the point where it's actually a downward sloping term structure, upper left to lower right, and that's called backwardation. Going back to the introduction of VIX futures in 2004, we've seen the term structure be in contango roughly 80% of the time. So the normal term structure for VIX futures is contango.
And so Rob, with your solution, which of course provides a hedge, hence the name, the Occurrence Active Hedge U.S. Equity Fund, a financial advisor doesn't have to explain all that, because that would be my nightmare, right? For a client to call me up and say, exactly what is the VIX, right? Why did it move so much? But you've got a package solution here that people can get comfortable and sleep at night, right? Owning basically large cap stocks with that insurance that Jim is speaking about. Walk us through a little bit about that structure and how it might work in extreme situations.
Sure, sure. One of the things that we benefit from is the power of convexity. And convexity, for lack of a better term, basically magnifies or amplifies your exposure, your investment on an exponential basis. For example, you could take a quarter of your portfolio, 0.25%, 0.25% per month. That's what we use. Allocate it to long vol. You say, well, that's not a lot, right? It's only 0.25%. But when you look at time periods when, and it's not a lot of them, you look at time periods like, the March 2020, 2008, 1987, you look at these periods where the markets face extreme volatility, you could have an options contract that you paid $1 for suddenly be worth $60, $70, $80. That's the power of convexity. So you don't have to hold a lot of the VIX options because of that embedded leverage that exists in that options contract. So you can benefit that in the portfolio one of two ways. First way is volatility spikes up. You may not capitalize on it. Those options may expire at the end of the day worthless, but along the way, they have helped dampen volatility because the price appreciation as stocks went down helped mitigate some of the downward moves in the underlying holdings of the portfolio, which in this case is the S&P 500. But with volatility, when it spikes, and then you can capitalize, so that's one piece, but when volatility spikes, you can capitalize on a large movement. The power really then switches from convexity to compound interest. And it's attributed to Albert Einstein that compound interest is the greatest invention of mankind. When you have the market at all-time lows, $1 is worth more at the low of the market than is at the top. I mean, we'd much rather prefer $1 to have dry powder at the bottom of the market. That's what we do. So we provide dry powder so that we can go in and take that hedge that has acted as a ballast for portfolio volatility, cash it in, buy these shares. So we accumulate more shares. We accumulate more shares in these companies at low prices with this dry powder, and then we get the compound effect, from that investment. So there's really two components here. One is the power of convexity dampens volatility, and then capitalizing on that with compound interest. And that's how we believe over the long term, over a full market cycle, as long as one of these events occurs, we only need it to occur really once every 10 years. And we believe on a risk-adjusted basis or an absolute basis, we could beat the S&P 500.
So when I'm listening to what you're talking about, your fund's active. What is the importance of the fact that it's an actively managed strategy? Because if it was passive, it would be completely formulaic, but you needed to be active, correct?
Correct. And we call ourselves systematic. And one of the things that we can do is, Jim mentioned, high vol regime. We look at volatility in regimes, low vol, medium vol, and high vol. For us, we would say right now, this is a medium vol regime for us. We really need for high vol to persist. We would see the VIX, mid 30s into the 40s. That's how we would define high vol. Depending on the vol regime we are, is going to depend how we trade our VIX options. And it's all been predetermined by algorithms that we've run in the past and systems we've run in the past and back tests. And we've been running these since 2017 live with real money. But depending on the vol regime, that's going to determine how far out we go, as Jim alluded to, the term structure. If we're in a low vol regime, like we were in, say, July 2018, VIX is 12, 13, we're going to go out and buy 6 months, up to 6 months worth of the VIX in advance. We'll go out and buy August, September, October, November, December. We will own each month's increment of VIX options at a 0.25% allocation to pre-position for that volatility, buying volatility while it's cheap. But when volatility is elevated, say mid to high level, volatility tends to act as a like a rubber band, right? It stretches out and then it compresses back. So we actually have methods where we can capitalize on the compression of volatility as well as the expansion, depending on the vol regime. So that dynamic volatility management that we provide depends on the vol regime we're in, and we are always monitoring that on a perpetual basis and making adjustments month to month to month to month.
Mr. Vixologist, when was the VIX created? I don't. How far back does it go?
Yeah, the VIX itself goes back, and it's gone through a couple of methodology changes over the years, because back in 1990, when it first appeared on the scene, you know, it was a bit of a different world. And initially, it was measuring the S&P 100, right, the largest of the large caps. But it does go back to 1990 in one form or another.
1990. Okay. And Rob, sorry for just kind of like flipping back to Jim. Everybody just feel free to ask questions in the chat, by the way. You know, when I'm thinking about the VIX, and maybe this is bad to say, but you know, in markets that are trending, things become like memes, right? Do you think that a lot of folks are gonna come into the VIX products, not yours, obviously, Rob, because you've got it wrapped as a solution, and just start trading some of the VIX products as memes?
That's a good question. I'll let Jim answer after this, but I think you have to be a little more careful with the VIX than you do with some of the other products that are out there. They're not quite as simple as a stock per se, because you have a futures component, and the weighting of the futures component does not equal the options weighting. And that's one of the first things that confuses stock buyers when they enter the futures world. The futures world, the multiplier of the options contract is determined by the underlying. You know, for example, in oil, it's 1,000. Well, in the VIX, it's 1,000 as well. In the stock world, it's 100. So if you owned, let's say, you know, you're short VIX futures and you want to try to hedge it with options, you know, there's some problems there. You know, one, the sizing, because you'd have to own 10 options per futures contract. And then the other problem would be is making sure the back office of the broker dealer you're dealing with knows that those options, which are European style, so they're not going to price intrinsic value, they're not going to be dialed in tight to the futures as would an equity derivative. You've got to make sure that their back office is going to, you know, recognize that as a hedge, so to speak, and you have to have the multipliers right. So there's a lot more to it than just being, you know, long or short. Jim?
Yeah, I think where the opportunity for meme trading comes in is really with the exchange traded products. Important for people to understand again that the VIX itself is not tradable. The VIX itself is just a calculation. It's based on a full range of S&P 500 options, both puts and calls, to try to replicate the VIX with a very specific 30-day maturity is virtually impossible, even with all the technology available for us today. A lot of smart people have tried and thrown their hands up. But where retail gets involved is with the exchange traded products. And you know, if meme stocks really started with GameStop and AMC back in the beginning of last year, I would argue that Volatility had its first meme event back in 2017 with XIV, because it was a one-way ride. XIV was up round numbers 90% in 2017. You know, that kind of performance does not escape people's attention. And so it attracted a lot of attention. It attracted a lot of assets. It attracted a lot of retail investors. It attracted a lot of advisors who didn't really know what they were getting themselves into. And as anybody who has paid attention to the vol space knows, that all came to a crashing halt in February of 2018 with what has been dubbed either Volmageddon, the Volpocalypse, whatever it is. But I would argue that XIV was a meme stock before GameStop, AMC, and any of the other ones. I'm not sure it had the Reddit forum back in 2017, but it was there. And, XIV is gone, but we still have a number of exchange traded products that allow people to express opinions in volatility, long and short. And, I wouldn't be surprised if, at some point in one direction or the other, we get, another significant retail following.
How liquid are the is the VIX and the futures? Rob, maybe you can answer that.
Yeah, there's a ton of liquidity there, especially we focus on we switch over to the options piece because a lot more people can relate to the options and the futures. Typically, the VIX options are one of the top 3 traded instruments on the CBOE with SPY and SPX. And what happens is, ironically, and this is a good thing, in periods of crisis where liquidity dries up for other instruments, with the VIX, the volume and liquidity goes up. It actually goes up. So I mean, there are instances of small periods of time where it might be dry, but for the most part, the liquidity is pretty substantial.
Yeah, which just as a reminder for everybody out there, so are ETFs, right? Just because they don't trade actively doesn't mean that there isn't absolute plenty of liquidity in the underlying. And we can note that particularly in the occurrence solution, regardless of how it trades on a day-to-day basis, given that it's mostly large cap S&P names, there's just a ton of liquidity in what you own. And I'm just speaking as the ETF professor.
Yeah, and I want to just add there, if I could interject for a second, a lot of advisors look at volume and they think volume is liquidity. Yes, if you have tons of volume, that is evidence of liquidity. But the inverse is not true. Lack of volume does not mean lack of liquidity. Liquidity, the definition of liquidity is if I enter an order, can I get it filled at or near where I'm, my ability to get it filled at or near where I'm entering the price. We have market makers backing our ETFs that are very, 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 very deep, so that at any given time when you enter in your order, you can get filled. You will get filled. There's tons of liquidity there, even though there may not be a lot of on-screen or screen lit volume.
So Jim, we've both been in the market for a long time, Rob as well. What kinds of different markets are the VIX most useful in trading? Obviously, if we've got just a directional up market, well, okay, easy money's being made. You don't necessarily need protection until there's that, as Ross Perot said, that large sucking sound where we're all screwed. Bear markets, bull markets, flat markets. What's been your experience?
So let's go back to the concept of volatility regimes for a minute. And there's really no accepted definition of a volatility regime. But, and Rob talked about, low vol, medium vol, high vol. I like to define what I refer to as an elevated vol regime as a period where the 1-year moving average of VIX is above 20. The long-term average is about 20. So basically what we're saying is if it's been hanging around above 20 for a year, then I'm going to call that an elevated vol regime. And if you look back over the history of the VIX, there were elevated vol periods from 96 to 2004. Okay, that captures the Russian debt crisis, the Asian contagion. It captures the rise and fall of the internet bubble. And then during the global financial crisis, really from early 2008 to 2012, end of 2012, you had that moving average of VIX hanging out above 20 for an extended period of time. Most recently, we've kind of triggered that with the COVID pandemic, and we're hovering right at that kind of 20 level. From my perspective, when we're in a less elevated regime, there is still a place for volatility in your portfolio. Again, if you have some experience and understand what you're doing. If you want to think about short vol, institutions have figured this out, and they use short vol as a way to either add some what they refer to as income to their portfolios, or effectively as a piece of equity replacement, if you will, because short vol in a bull market is, think of it as S&P exposure with a beta of between 2 and 4. So I'm getting equity-like returns. They're correlated with equity returns, but you got a little multiplier on it. So there are institutions who look at short vol in, kind of bull environments as an enhancement to their portfolio. And then the flip side is, clearly when you're in an elevated vol environment, you may want to lean the other way and look at long vol as a hedge, the way Rob's structure uses it, and there are other ways to implement it. But I maybe it's because I'm the Vixologist and I don't want to see any period of time where there isn't a role for volatility to play. But I would say you just need to understand where you are in the market cycles and where you need to be leaning, either long or short. And I would also emphasize that in environments like we seem to be in now, where it looks like you need to be switching from day to day, there is a role for active management, tactical management, for what might be referred to as a long-short approach to managing volatility.
So Rob, this is a little bit of a curveball question, and maybe it should be directed at Jim, but the VIX isn't, in your studies, because you've done a lot of studies on it, the VIX isn't related to the bond market at all, is it?
No, it's mostly correlated to, or inversely correlated to, the equity market.
The equity market, right? And I asked the question because one would have to expect that it wouldn't be correlated to the bond market, because the bond market, with some rare exceptions, when things in the past have gone really badly, right? It's been trending very neatly, right, in terms of price. I'm thinking TLT. So usually I would expect when TLT, as an example, has rallied in a big way, it means the equity markets have gone down, right? And VIX might be going up, but today that's just not necessarily the case, because we're watching TLT kind of go down a lot, except for right now, at this moment in time. I bring that up because when I'm trying to figure out where we are in the conditions of the market, I'm really focused on the bond market, and I'm looking very closely at the volatility in that market, right? Which gives me even further reason to focus on this asset class. Maybe it just makes me nervous, to tell you the truth. Am I off base in thinking like this?
No, I think we live in unprecedented times. I think a lot of the back studies we do, and I won't go into too much detail, but when we look at some of the testing that we've done in the 2008 environment, or even 2001, 2000, a lot of those tests that we've done and run, just because the option markets are so different, the markets are different, they're not as significant, they're not as meaningful as they are today. We are so sensitive to news. More people are trading, the markets are faster than they've ever been. And when we think now that, seeing an event like 1987, and by the way, to Jim's point, prior to 1990, the CBOE went back and used OEX options, which is the S&P 500, and they looked at and modeled the VIX. Well, on October 19th, Black Monday, when the market's down, 22%, the VIX as measured by the CBOE with that metric would have hit 150. 2 days later, it would have hit 172. And I think today, the environment we're in now, that was a feedback loop story with portfolio insurance. A lot of it's attributed to, back then, there was a major firm that was selling portfolio insurance that when the market hit a certain level, you would just get out, right? It sounds nice. Well, you get out and then you sell if it goes lower, and selling begets selling. And that created a negative feedback loop. And what we see today, we see a lot of feedback loops in the market today. And we don't think it's unheard of, thinking about how the VIX is built. If you think of the VIX, you're looking at out of the money options prices on puts and calls. And if you look at each little bid ask that's measured, for lack of a better term, if you were to call them strips, right? So that you have these strips that are being, every 7 seconds are being refreshed on the CBOE database to report the VIX. What we see could happen is the market, not unlike the flash crash, where we see that extreme pressure, where market makers kind of pause a little bit and they step back, and they turn their machines off. Some of them, not all of them, but some of them do, or they'll change the parameter. They'll flip into another mode, and I can give examples and prove that that's happened. But what we're afraid of is in this negative feedback loop that a lot of those strips that are measuring the VIX will disappear, meaning there's less data to compute the VIX number, which could artificially, for a brief period of time, escalate the VIX and shoot it up, maybe over 100 or something. Now, it wouldn't occur for a sustained period. It might only be for a few hours, but we do see in this type of environment a sensitivity that we've never seen before.
Yeah, because I guess part of what you're saying is, and maybe this is not the right language for it, but there's times where the VIX is cheap, right? And there's times where the VIX is super expensive and elevated, right? And Rob, in your context, you reap the benefit of when it gets super expensive, right? And that's part of the reason why you need active management to know when to trim back. Is that fair to say?
Exactly. And we get often asked, so when do we cash in on these VIX? Well, we always have to be hedged. So by definition, since we have to be hedged, we're going to hold those options to expiration, because we're not going to sell them, try to get what we think is a good value, because then we'd have to re-hedge in the same vol regime that we just exited. So we always have to be hedged. And in fact, we would have to actually do it before we exited, which is even worse. So we let those options expire, let the market decide, the marketplace decide what they're worth at the end based on the measurement of the VIX. And having that exposure benefits our portfolio in those environments.
All wrapped in ETF, tax efficiency, and clients don't have to ask you a whole bunch of questions that really only Jim could answer. I'm just kidding you.
Yeah. No, can I ask Rob a question about that though?
Yeah, just a segue on that real fast, Jim. You've got to open up options paperwork. It's a lot of paperwork. We had a firm that we went into. We work with various firms. We, multiple strategies we run, and a lot of firms don't have the existing options paperwork, and it's a pain to set up if you haven't done the work ahead of time and decided you want to trade options. If you have to do it after the fact, it could be several thousands. Depending on the size of your firm, it could be several thousand pieces of paperwork to process. But you don't have to worry about that now.
Go for it, Jim.
Yeah. So Rob, if you're holding options to expiration, so let's go back to March of 2020. If you entered and just work with me. So you're in January of 2020 and everything seems to be okay. And you've got your VIX options in the portfolio with expiration dates wherever they are. I'm guessing, but I wanted to clarify that you've got, multiple expiration dates on your VIX options exposure, so that you don't have it all hanging on one expiration date that may be out in the future, where if you held it to expiration, you might ride it all the way up and then ride it all the way back down without, realizing the benefit of that hedge exposure.
Yeah, there is some risk there, and we will always own the front month. We'll always own the front month VIX, monthlies. And so we're always going to have at least 30 days exposure, maybe 33, 28, somewhere in that time frame. But to your point, in February of 2020, we owned VIX at a 17 strike. And, in that time frame, we were, as a firm in February, we bought an extra backup generator, and we bought some filters for N95 masks. This is in February. And this is just how we think. So we prepare for the future. By nature, we're paranoid, and you want us to be paranoid because we're running your money. And to me, paranoid people, to a certain degree, as long as the paranoia doesn't prohibit your thinking, is a good thing to have for a small slice or a piece of your portfolio.
Hey guys, we've got a question in the chat from Vittorio. I hope I'm pronouncing your name correctly. Vittorio,
Yes,
you want to ask the question?
So my question was, in 2022, trading volatility products, whether we go long or short, it has been very frustrating because, sorry, I'm on a treadmill, because the signal has been switching from long vol to short vol, just from a day-to-day basis. So many volatility traders have been, they lost money, so to say. So why with the market declining by more than 15%, we are not seeing the VIX 30 days slow yield well below the VIX spot value? Because honestly, I would have expected, the VIX 30 days very well below the VIX spot, given the current market condition. Does it make sense what I'm saying?
Yeah, no, I can handle that. No, I think what you're asking is, and I'm getting this asked a lot, why the VIX just doesn't seem like it's reflecting the environment we're in today. It feels like it should be higher. And I agree with that. And I would say, one of the things that I see is if we think about how the VIX is constructed, it's based off of options prices on calls and puts that are out of the money. And out of the money are used because in the money tend to be less liquid. And that was how the original formula was created. And if you think about the dynamics of supply and demand, when there's lots of demand, what happens to the price? It goes up. Well, what we've seen is, because we all know inflation's been coming, we all know that the Fed's going to raise rates. We all saw the Ukraine thing happening. What's happened is the demand, where usually historically that demand would be in a small window of a few days. All these people would race and go to buy the options, which would immediately raise the price of the options that are reflected in the VIX index. That's not the case today. What we're seeing today is the demand has been spread out. More people have hedged earlier, more people have put their hedges in, so that demand rush hasn't exhausted supply in a meaningful amount. And that's one of the primary contributors, we believe, as to why the VIX has not really gone as high as it has. I'll let Jim jump in if he has anything he wants to add to that.
Yeah, I guess the other observations or two observations I would make. One, if the VIX is 30-ish, right? The shorthand is to divide it by 16 to estimate the expected one-day move for the S&P 500. So, we're in the neighborhood of 1.5 to 2 points a day, and that's kind of what we've been seeing. So why does the VIX need to be any higher? The other thing we've seen just, in the last several weeks with this move lower is that it has been a steady grind down. And if you think about volatility, right, a straight line from lower left to upper right, the perfect bull market has zero volatility. And that's what we all want to see, right? But the inverse is also true. A straight line from upper right to lower left also has zero volatility. So when you're grinding down in this steady fashion, it tends not to cause VIX to go higher, even when everybody says, holy cow, we're getting crushed every day, we're losing money. But, if you combine what Rob said with the idea that, a steady decline is no different than a steady rise, they're both, relatively low volatility in the grand scheme of things. That's what you're going to see reflected in the level of VIX and to a certain extent the VIX futures. Now, what we had seen in the VIX futures up until just a few days ago was we had seen the VIX futures term structure in backwardation during this decline. And, that is a headwind, for short volatility. And that's a sign that, the people who traffic in VIX futures are not happy about the market environment.
Yeah,
but it has been back to your point, in choppy markets, trying to trade volatility from either side is challenging because you do get whipsaws and you've got to be incredibly tactical, and most people simply aren't equipped to trade that way. So yeah, you can get chopped up quickly.
And I'll just add one other thing. So in addition to, we think people have been hedged longer, because when we have a 3% move in the S&P, the VIX should be 40 and above when that occurs. That just hasn't happened. The other thing that's happened that we believe has contributed to a little more muted VIX is the rate of change hasn't been as fast. I mean, we literally, it's like stair stepping down, and a lot of our programs run on rate of change and price movement. And the VIX, the vol just has, I mean, vol is very low right now because the volatility isn't moving that much. And that's another contributor to the low VIX readings that we're getting, we believe. So,
well, guys, we're almost at the top of the hour. This is the time where we turn to the financial advisor, and which is Jim in this case, our resident Vixologist, and have you mention a charity that is important to you?
Dan, do we want to address the other question that's in the chat? It's just up to you. You're the host.
Well, no, I mean, you're talking about the one from Matt?
Yep.
Okay, so Jim believes the VIX is the best way to smooth out some of the volatility for investors in the U.S. equities. Is that the question you're talking about?
Sure. I just, that's the question. Do we think VIX is the best way? Go ahead, Rob.
And I think we have a vehicle for that. We pitch the vehicle that we've developed as the core. I mean, right now I know advisors that, they own SPY or IVV or VOL, and they're sitting on a 15% loss. They're worried about the future. I mean, some advisors I know are taking that tax loss, replacing it with our vehicle, knowing that we could lag a little bit going forward, but now they have that piece of protection in that portfolio. And now they can look the client in the eye who is thinking about going to cash and saying, look, if we stair step down like this, just hang in there. It's going to reverse. This isn't going to hedge against that. But if we see China go into Taiwan, if we see some tactical nuke being used in Ukraine, and that were to reflect in the VIX in a meaningful way, this portfolio has the potential to benefit for that. And I think that's how you can mitigate the volatility.
Dan, I got to hijack you with one more question for Rob.
Go for it.
So, as you know, Rob, there are a number of products out there that attempt to structure a hedge with, long equity exposure. You've chosen to use VIX options as your hedge component, where a bunch of other structures use S&P puts, for example. What do you see as the advantages of VIX options over index puts?
Some of that is proprietary, but I can say this. It'll answer it. In our analysis, we have found VIX options in extreme events to be more favorable than SPX or SPY puts, and that reflects both from a return standpoint and a premium, what we paid for it. That relationship between kind of what you're getting for your money. So with our analysis, and I'll give a little hint. Most of that was derived by going further out. You just don't see the price appreciation in VIX options, depending on the vol regime you're in, that you will see in SPX or SPY.
So you think you're obtaining the same protection at a better price?
It's not defined protection. We're giving up that definition, right? Because if you're using SPY, you know the notional, you can tell point for point, penny for penny, exactly how much you're hedged. We give that up with the VIX, and we acknowledge that. It's a little bit of a crapshoot, so to speak. But we believe the benefit of being able to use a little bit of capital and getting that convexity, that power, it's like a lottery ticket. We believe it makes it worth using the VIX, because we think people can, with a good advisor, good diversification, that you can get through the 10 to 15% down, but not the 50%. So we're focused on the real extremes. While we can make some money and dampen volatility and lower vol regimes, we will shine when that volatility really spikes, as evidenced by the VIX.
Back to you, Dan.
Well, no, I mean, Rob, where can we find out more about your strategy?
Go to www.occurrenceetf.com, and you obviously look at our prospectus, see what we're doing, look at what the risks are, and that's where you can find out everything you want to know. And feel free to reach out to us via email or rob@occurrence.com if you have any individual questions, and happy to help. And
Jim, before you sign off, definitely tell us where folks can learn a little bit more about what you do, and then also please speak about your charity.
Sure. The best way to follow me is on Twitter @Vixologist. My DMs are open. Happy to take questions from people who want to understand more about the VIX complex, as it were. And my wife and I were blessed to create a family through adoption. We have grown kids who were both adopted through the Gladney Center for Adoption down in Fort Worth, Texas. And that is my charity.
The gift of love. With that, gentlemen, thank you very much. We very much appreciate you joining us in the think tank. And be safe, everybody, and have a good day.
The views and opinions expressed during this event are those of the participants and do not necessarily reflect the views of the sponsor or organizer. Information set forth during this event has been obtained or derived from sources believed by the participants to be reliable. However, neither the sponsor nor the organizer make any representation or warranty, express or implied, as to the information's accuracy or completeness, nor does the sponsor or organizer recommend that the information shared during this event serve as the basis of any investment decision, and it has been provided to you solely for informational purposes only, and does not constitute an offer or solicitation of an offer or any advice or recommendation to purchase any securities or other financial instruments, and may not be construed as such. Past performance does not guarantee future results. This interview is being distributed for informational purposes only and should not be considered as investment advice or recommendation of any particular security, strategy, or investment product. It does not constitute legal or tax advice. The information provided is not intended as a complete analysis of every material fact, and the underlying assumptions and views are subject to change based on market and other conditions. All investments involve risks, including possible loss of principal.